I guess I'm one of the leaders. My name is Hadley. I'm a founding general partner at a fund called Eniac Ventures based here in New York. I think I heard someone pop up or mention they were hosting this with me. I didn't get a lot of instructions.
Yeah, I didn't get, I think I got the same amount as you. I'm Kate. I'm a principal at Homebrew. We're a seed stage fund in San Francisco.
Oh, cool. Yeah, friends with your partners. Yeah, I didn't get much instruction, so I guess Kate will just wing it here. I was told this about shifting priorities in a changing environment, so I imagine this is kind of how to, but open to kind of talk about anything. I imagine this is to talk about kind of as founders, how you change kind of what you're focused on from, could be fundraising, but probably more kind of running the business and how that's changed over the last 5-6 weeks. Does that sound interesting? Or sure. I'm happy to talk about anything.
If you could make a quick intro on your like investment philosophy, sweet spots, and kind of like processes, that would be really appreciated. But also that's a great question.
Oh yeah, sure, happy to. Yeah, so I founded Eniac about 10 years ago with 3 of my friends from undergrad. So we were all engineering students at Penn back in the late 90s, and then all became entrepreneurs and either started or helped grow, I think, 12 venture-backed businesses. Did that for a while, and then started investing in 2010. Grown ever since. We're in our 4th fund, which is 100 million. Team is split between New York and SF. Bread and butter is leading seed rounds. We tend to focus on more technically driven businesses. Probably lead kind of 7 to 10 investments per year. Yeah, that's us. Usually do about half the round.
This is easy because Homebrew's strategy isn't too different from Eniac. So we are around 7 years old. We're investing out of our $90 million 3rd fund. There's 3 of us on the investing team, but similar, we invest across industries, but with a bent towards mission-driven founders and businesses that are democratizing access, whether that's to data, to customers, to new revenue streams, et cetera. We're also generally leading or co-leading seeds. Average check size is anywhere from $500,000 to $2 million.
All right.
Any other background that could be helpful, or do you guys want to fire off questions? However you think is most helpful.
We have what are we supposed to be talking about?
Yeah, I was mentioning shifting priorities in a changing environment.
Yeah. Well, I can go first.
Yeah, go ahead.
So my company is Market Proof, and we're in the real estate space. So we are a data platform, and you know the real estate is. I mean, it's amazing how quickly everything has changed. It doesn't matter what sector of real estate you're looking at right now. The whole thing is completely upside down. And there's so many, big open questions in every sector. If you're residential, commercial, office, are people going back to office spaces? Are people going to be working more from home? Do homes need to be reconfigured for more office space? And so we're working on kind of changing our models to address what we see to be really just tectonic changes in what's going to happen. The risk profile for everybody has changed so much. And when we looked at it, we see the investments that have been made across all these sectors have come under question so much that we really changed our strategy to address some of these things, because having all this data, we're able to see how much stress there is in some of the sectors. So it's really for us in the last 6 weeks, we've really shifted our strategy to really focus on super high value problems where the answers are really unknown at this point. But what we see is that some players are going to lose vast amounts of money, and other players are going to make vast amounts of money. Maybe some of the most obvious examples of this are some of the Airbnb stats that you've seen out there, where urban volume is down 60, 70%, but rural volume is up 60 or 70%. And in New York City, where we're focused, you have, $30 billion of new condos that have not been sold. And what's the likelihood of those condos being sold anytime in the next couple of years? So that's kind of I don't know, maybe in other industries, the changes aren't as vast as what we're seeing in real estate. So I'll just put that out there as just kind of a starting place to start a discussion about what we're dealing with here.
Yeah, I can maybe start off kind of at least at a high level in kind of what we're seeing with our portfolio. We spent the first couple of weeks as this thing started to really ramp up, trying to assess kind of how everyone would be affected. Every company is different, but to me there were kind of three major buckets. There was a relatively small group of what I'd call like pro-cyclical companies that think like esports, some e-commerce, distributed team-oriented stuff that are actually helped by this environment. I think it's relatively small. Then you had kind of the other end of the spectrum. There was some things involving physical retail and things like that just really got crushed, and maybe some real estate would go in that. And then you had the middle bucket, which I think is at least the mass majority of what we do, which I'd use the example of is a lot of SaaS companies that they're not really directly affected, but just kind of the residual effects of the economy slowing down and things flowing from kind of those other companies that got really hurt badly because they just had to cease operations. We have a company that is a robotic system that cooks meals within offices. Pretty much all the offices closed, and they had to make really quick adjustments, and now they've been rolling them out to first responders and hospitals and stuff like that. It's trying to make lemonade with your lemons. So anyways, it's just like, at least that was a framework I understood. And my guess is that most of you kind of find yourself in one of those buckets, and kind of depending on where you are, I think your adjustments are going to be very different, where when you're in kind of the really hard hit ones, you really need to take drastic action. Some of the ones that were kind of pro-cyclical are probably actually speeding up and maybe considering hiring. And then everyone in the middle, I think you have to, especially kind of if you're kind of most SaaS companies, you have to assume a relative slowdown for at least the next couple of quarters. Rethink of how you do your sales. Think about, start to expect for higher than expected churn, and start to kind of bake that into your plans and kind of understanding how that will affect your burn and your runway. I know that's kind of high level, but at least kind of how we're thinking about it.
Yeah, that's similar to how we're thinking about things. I think like with the additional nuance of like that middle bucket has like there's a pretty wide breadth of actions within that middle bucket. And I think a lot based on the company, like the business, as well as the stage of the company, where if you're still building out your product, it's much more likely that you are going to fail rather than the economy will fail you if you are still building and you're still looking for product market fit. And I think that in a lot of ways that's like scary, but a lot of ways it's good that for many of you guys that are still at this like very early stage where you're still pre-launch, you're still building your product, you still really control a lot of your own fate. It's much more likely that you will be able to kind of find product market fit and launch into something exciting, even if the underlying economy isn't great, so long as you're not potentially doing something around like, consumer travel and you want to launch tomorrow.
Yeah, maybe to add to that, especially kind of the more dynamic your industry is, I think it's the more it can be, especially, it can be a drastic change and hurtful, but it also the more there might be opportunities to really make quick changes and take advantage of the situation. This is a time when I think startups like we work with and all of you are really kind of at an advantage versus large incumbent companies that just are going to move very slowly comparatively. And that's kind of the beauty of startups, but in this environment, it's kind of that beauty's, I feel like, on steroids. So it's a good time for founders to kind of take a step back and assume nothing about their business and think about, okay, what opportunities are arising that we can jump on really quickly and take advantage of what might be a temporary situation, but more likely things that we feel or you feel will be lasting changes within society that would have probably taken longer to happen if it wasn't for COVID.
Anybody else? That
Yeah,
was a topic I thought just to get it started, but we can
Yeah,
talk
no,
about it.
thank you.
just to echo what Kate said, I think we've also, my business is pioneering admin tech. So we are empowering administrative professionals, so executive assistants and admins, which is an interesting space because they book the world's business travel. And so right now they're a little less busy than usual, or they're shifting their focus at least now to kind of like what Lauren is doing here, running webinars.
Mhm.
So it's an interesting space, but one thing we've shifted, we've done in shifting our process is using more data to drive product development decisions. So focusing more on engagement rather than customer acquisition. So I don't know if maybe you, Kate and Hadley, could speak to, you know, what you're going to, kind of expectations you have for, you know, like you mentioned, like kind of pre-seed, maybe just post-launch, but really pre-revenue companies the next, you know, 2 years.
Go ahead,
I think
Kate.
the good news is you probably get a pass for no customer acquisition or no growth in at least like the first half or the foreseeable future of when everybody is locked down. I think that for better or for worse, like people are kind of give you like a do-over for growth during the time when the world is locked down. And so what we have been advising our portfolio companies and folks that we work with is to really pull back on marketing spend. That's the easiest place for you to pull back from everything acquisition related, unless you're in one of those kind of like counter cyclical categories. And in that case, like lean into it. But for most folks, pull back on marketing, focus on really like getting your product nailed down, focus on retention and customer engagement, and on, you know, making sure your team is in a good place as well. Like make sure that your team is set up so that when hopefully the world does get back to normal, you can start executing at a faster than ever before pace.
Yeah, no, totally agree on the marketing front. I think the other thing is, and this is also dependent on kind of what kind of types of businesses, because some products lend themselves to certain types of go-to-market, but from kind of a sales cycle, especially B2B companies, this is an environment where we think kind of generally more like bottom-up approaches will work better. If you think about the prototypical like kind of developer tool where individual developers can start using it kind of on their own, that shouldn't have too much of an effect because they're kind of home working as it is. Whereas kind of a very large enterprise sale top down, we think is going to be more difficult. Those usually involve in-person meetings. So again, you don't want to kind of try and shove a square peg into a round hole if it's not the right thing for you, but that may mean kind of, for example, well, let's focus on a little bit of smaller businesses during this time. We know we can make headway. We can get some early customers instead of going out and elephant hunting. So just kind of being reactive and trying kind of smart around what can work in this environment so that we can make progress. But agree with Kate that you generally get a pass, but unfortunately, you know, 18 months from now, when you haven't hit your numbers, people are going to forget, or, you know, they're not going to remember it as well. So you do, you know, need to make progress and then kind of position yourself well for when hopefully this starts to loosen up.
Yeah, I got a question. So I'm in one of those counter-cyclical ones. I run an e-commerce beer platform based in Brooklyn, and we're up a stupid amount since COVID happened. Obviously,
What's it called?
Called Taproom, TAPRM. Yeah, and you know, we're doing, you know, we were probably doing 30 packages a day pre-COVID. Now we're doing 700. So, you know, we're up a lot. And to your point about investing, you know, I'm getting a lot of both sides of this. You know, spend all your cash in marketing right now. Digital conversions are cheapest they'll probably ever be in the history of time, in my space at least. If you can just raise more money, throw it there, you know, at $5 a conversion for everybody buying $70 a beer, you know, it's almost unheard of. And so, but I'm also getting the side of this is conserve cash. No one's going to give you, you know, the money you really need to do a good Series A right now. You'll get, you know, worse investors. Maybe conserve it, you know, see how long this plays out. I'm just curious I mean, I've heard both already on this chat and the one before. As far as like marketing spend goes for counter-cyclical companies, are you telling people to really dive in right now into that space, or kind of be cautious, like bleed into it, raise the money first, then spend the marketing? I'm just curious where you guys would make recommendations right now.
Yeah, I mean, I guess it depends on your business. We have some overlap with one of our portfolio companies called Box, that's kind of like e-commerce wholesaler. So they just kind of been getting crazy volumes. I mean, you may be kind of similarities where they're focusing on earned media because it is kind of getting the word out, but really it kind of turned off a lot of paid media. You may also be running into this where as you're ramping up, you may just not have the bandwidth, or the supply chain might not allow you to meet all that demand. So it really doesn't make sense to be spending a lot of money. The one thing I think that they've been doing well that also may have overlap to you is like focus on long-term customers. So in their case, they have kind of this thing called Boxed Up, where you can, it's kind of like it's like a subscription platform. So, you know, people may be rushing to them to get toilet paper, but if that's a one-time purchase, that doesn't help in the long term. But are there things that you can do to kind of capture them, collect data, and make them long-term customers when to make sure they don't revert to their, you know, prior way of getting beer?
Yeah, I would echo that. We have some overlap with we're investors in a company called House. That's a D2C aperitif brand. So pretty similar in a lot of ways. And they have kind of seen similar spike in demand as everyone's drinking at home. And I think what they've been focusing on doing is making sure that as they increase marketing efforts, that again, they're focused on long-term customers and how they can convert these like pandemic customers to ongoing. And then also doing things that they feel are really like consistent with their brand and can lead them to not just be another D2C alcohol company, but take a real stance. So they've been partnering with local restaurants to release like limited edition flavors, but like thinking about what they can do that's like net additive for their community while they have this like spike in demand to hopefully to do good, and then also you know, fit their mission.
That's good advice. Yep. Just a follow up on that, are you recommending to those companies to spend it all right now, or are you saying go raise more money to spend, or are you kind of saying just hold off and wait and see how things are going?
I don't think we'd advise anybody to spend all of their money right now.
That's good. Yeah, no, that's good advice.
Yeah. I don't think I don't think you want to be in a situation where you spend all your money on acquisition and then 2 months from now you're forced with doing some drastic things like shutting down the business or laying off a significant portion of staff if you can't get Series A funds to raise the money. I think if you are seeing like an unprecedented spike in demand and the only thing holding you back is capital, then you should begin to have conversations with people who can give you capital, as long as you don't feel it would be distracting to the business. And as far as that goes, I think, you know, your current investors will have the best read on this as well, but folks that you've met before in the past will likely be easier to get done than like starting brand new relationships with folks that write Series A size checks. I think, yeah, that's what I would recommend. Yeah. Obviously hard to know without seeing your actual numbers, but yeah.
No, I was just more curious about House and Boxed in particular, but yeah.
Yeah, I think there's the next session's fundraising, so I don't want to get too much into it.
Sure.
But I think at least with Box, you know, the thing is the fundraising has been difficult the last few weeks. I think that hopefully will start to kind of shake out a little bit. So I think Kate alluded to this, like fundraising takes a lot of bandwidth and your attention. And if you have this kind of unprecedented opportunity to really capture demand, that could be really difficult to do at the same time. So if there are easier ways to do that, whether you have existing investors that might kind of do a note and then you can raise, you know, a few months from now, that kind of thing would be, I think, advisable, you know, as long as they're reasonable. Or as Kate said, kind of folks you already know, because going from scratch, I do worry that you'll be juggling a lot at one time in kind of a tough environment.
Yeah.
I have a question that's much earlier than probably any other company here, but we are doing a primary care membership space that's brick and mortar. Luckily, we don't have the space yet, but We just raised a small pre-seed and we've been doing some market research, doing surveys, one-on-one interviews and focus groups. Do you find that those might be unreliable right now? Like we can't get a good sense of consumer psychology and behavior, and maybe we should hold off or do another round after this is over, whatever that is.
You want to head? Go ahead, Kate.
Yeah, I think it probably depends on what questions you're asking them. I think for you, your space is obviously so much more closely tied to pandemic and pandemic prep, as well as like brick and mortar is hard for people to wrap their heads around now. But that said, like people have only been living in this like new world for a few weeks, and I hope that the folks you're talking to can like imagine what life was like before and after pandemic. So I would say like obviously like filter things out, but I think like I would generally rely on your customer research as long as you're taking everything with like the grain of salt that you should honestly always be taking things when you ask your potential future customers what they think like they want their healthcare to look like in the future.
I think that makes sense. I don't have any particular experience with this.
I had a good question then, since everybody's silent. So,
thank you.
Are you in position to be investing these days, or is it better? So, and is it basically better to find a warm intro to you, or is this class a warm intro enough to slowly start getting to know you and having a conversation as far as potentially joining our seed round?
Yeah, we are investing. I think we're just finally kind of coming out of a really time period for 4 weeks ago or so. We're just really heads down with portfolio, but now that the wave of kind of triage and now PPP and everything seem to be kind of subsiding, we are making new investments. So my email is Hadley at Eniac.vc. You're welcome to kind of send me some materials.
Yep, same for us. We've been making investments. We've made a few since lockdown began. I'm Kate at homebrew.co. So send over a note.
I think one of them we did together.
Yeah.
Oh, nice. Yeah. 2 for 1. That's great. No, to me, it's just like it's crisis time. It's a very rare opportunity to, like, California has been. I'm from Ukraine originally, so we're like kind of a little tougher than they are in California. And I was
I was in Ukraine this summer. That's definitely true.
I'm the smiley. Like it took me a decade to learn to smile for no reason, but it's just like it's a rare opportunity, and we were caught in the middle of both. Like we've been considering with my girlfriend to move to New York, and then we were in the middle of seed fundraise when the COVID hit, and we actually had some success with Japanese investors because they used to live in Japan, and so. But then like Asia got hit first, and then we shifted our conversations to US, and then US got hit second. So we're careful in shifting our conversations with investors to the next region. But it seems like a really interesting opportunity to see who the really kind of more brave and more kind of like direct people are, because seed is the best time to build right now. It's just like the talent is amazing. The CPMs, like my girlfriend's in paid acquisition. She used to be at Uber, and now she's at SoFi, and she's been poking me for the last like 4 months, being like, hey, you should focus on growth. You should put a little bit of money behind paid, because we've been trying to do the organic growth for quite a while now. And so she's like double down on that. And now, since I procrastinated a lot on that, prices have gone down so much that this might be sort of like the perfect time to be doing that. So I'm just curious, how is that like, or is it better? Like some of my friends were just like, hey, some of them are kind of like old school VCs that are like, just like go complete cold turkey on any investor conversations, take like 3 to 4 to 5 months, wait till this thing stabilizes. But part of me is just like keeps going back to fundraising, and like my girlfriend's like, you should stop fundraising, just keep building. And I'm like, but it's a great opportunity to test people's character. And so I'm curious how you think about that.
I think now is a good time to start kind of, especially for a seed round, to get going. I've been advising folks to kind of hold back because I just worried, some folks have been active like Homebrew, but I think a lot of folks were kind of heads down, and I just worry it'd be kind of like pushing a string. But I do think that now investors are starting to have more bandwidth. And then I think seed investors tend to be a little more, risk tolerant. So I think they're kind of more used to operating in an environment with a lot of unknowns versus kind of Series A and B investors, which I think it's a mixed bag now, but I do think a lot of them are kind of still inward focused and kind of waiting to see how this thing shakes out. But as an investor, this should be, while there's unknown, it should be a good time for us to invest. I do think that, unfortunately or fortunately for kind of whoever's involved, like prices have probably come down a little bit. We're coming out of a very frothy time, so that I think has gotten kind of reversed. But the other thing maybe to add is I found our very early companies actually needed to make less adjustments than kind of the companies that raised like big Series A's and B's that I was working with, because they have all this growth kind of packed into built into their plans around burn and runway. And so those were the harder situations where they did need to back off because they're going to likely miss their numbers for a quarter or two. Whereas just the early ones, as you're just getting going, there's kind of less to change.
Yeah, I would echo that. The only thing I'd add is like, if you had envisioned your seed round being full of like individual angels, that might be a thing that is harder to achieve now. And so I think I think like those folks are probably like a little bit more hesitant these days as like a general group, as their net worth has fallen significantly. So I think like if that was like really, really important to you, but I think that most of the seed funds we know are definitely looking to do investments today.
Yeah, no, that's a great point. I was thinking more funds, and as you're probably aware, kind of funds, we're raising money every few years. So we have the money kind of available from prior. So it's not like we have a moving target, like an individual who may have lost, 25% of their net worth over the last 2 months.
Yeah, I was hoping to bring in some angels into the round because I think having more builders in the round is great, regardless of check size. And I was curious what your thoughts are on the, so like we've been raising, like we raised angel round in beginning 2019 on YC safes. We've been raising the seed round, which I made a transition. Like one firm wanted to do a priced round, and we made a transition early this year to safes, and sort of like half of the round came together on safes, which was great because money was already in the bank when this thing hit. But I'm curious, is there a particular number of safe sort of like documents at which point it becomes a concern? Because a lot of people are saying, keep the cap table clean. And so at which number does it become a concern from what you've seen historically from companies going to a successful A, B, C, and beyond?
Go ahead, Kate.
I don't know if I have an exact number. If Hadley, if you have a number in mind.
I don't have an exact number either, but I don't think it's not about the number of safes, but I think around the money that's on safes. I think you start getting over a few million, and it's kind of considered bad practice. Things have changed a lot because now you have post-money safes, so at least you have a better feel for where you are. When it was pre-money safes, that often would cause issues. But if you're assuming if you're planning on raising a Series A, depending on how big that is, you don't want the safes converting into the A to be like a really big chunk of that, because that can throw off the allocations. So
yeah, no, we're doing post money safes. We're keeping it super clean. I'm just curious, like there's a few technical CTOs at companies in like we're slightly in the crypto space, so there's like a few really, really great people there who as angels, their check sizes went down significantly. So I'm curious, what's the cutoff? Would you have a cutoff number? Like I'm of a view, if a person wants to put in 5 to 10K, they should be able to do so. But is there any sort of like concerns there? Because we've heard that some VCs prefer, especially on the Series A, they prefer to see a super clean cap table, and so
they do. Are you asking if there's a minimum amount that you should take money at, or a maximum number of safe notes that you want to have,
both.
Or maybe it's both?
Both, yeah.
Yeah, it's probably a better question for a venture lawyer, but it is considered best practice to have a clean cap table. Also, other than the thing I mentioned about having just way too much money in a safe that would convert into the round, I think it's not a huge deal compared to like how your business is doing, in terms of, if you have a bunch of small safes and a Series A investor is excited about what you're doing, they're not going to not do the deal because of like cap table cleanliness. But where you can, I think they prefer to see it with less nodes.
Yeah, and then I would say if like you have a bunch of folks that all know each other and they all want to do like 5K checks, like seeing if they can come in as a syndicate together, like that can make your life a little bit easier if someone's organizing that. But yeah, it'll end up being a lot of work for you on the tail end too, because a lot of that like cleaning things up and getting everybody to sign documents will fall on you inevitably. So it's just sort of like pushing out some pain.
One of my friends raised like I think almost an A round from 70 different investors, or maybe it was close to 100, and he's like, no biggie, worked out fine, and now he has a Salesforce, and now he even has an automation script that basically twice a month it like finds who to introduce to and finds who can introduce to all automatically, and it just like pings those people, and it's basically a Salesforce, and he's in like this marketing automation tech, so that's just like a perfect sweet spot for him. I don't want to go that far. We have like 5 saves. We have like 5 saves right now for seed. I'm thinking maybe keep it within like 10, like 12, 15 tops is kind of like the top line that I'm thinking. So it sounds like it's reasonable.
Yeah, I think that sounds about right. Also, I think to your point, like investors can be kind of a cheap way of getting advisors, can be really helpful. If they weren't investors, you probably have to give them an advisory agreement. So in some cases, it can be a great way of kind of having folks around the table that can be helpful.
100%. That's why I'm talking about that, because like smaller checks has actually been so much more useful than some of the bigger checks who are much more busy. So I was like, we're not paying the money, like they're paying us money and they're helping us a lot. Like sign me up. And the last question on the venture side for you two, what's the minimum check that makes it in? Because like funds have the responsibility to return funds and everything else. What is the minimum size of the checks that makes it interesting for you to work with the company and allocate bandwidth for your resources?
I think it's more about ownership than the nominal amount of the check. For us, like we aim to get 10 to 15% ownership. Our model is super high engagement. And so for us to spend that like an hour every week or every other week with companies amount of time, plus like work on the back end, we just have to have a lot of skin in the game.
Yeah, we're the exact same. And we tend to be kind of rigid, for better or worse, on the 10%. We haven't done an investment for less than 10% in about 3 years.
Some funds are really strict about it. I'm first time kind of like official entrepreneur on this side of the ocean, but it is a concern, a constraint a lot of funds have. So it's good to know.
Most funds, I'd say, are less strict about it than we.
We're a little less strict, but like, we're only less strict to a certain point. So yeah.
Because we're out of here in 12, 11, 10.
Get it
All
in
right.
quick.
Well,
I hope I
thanks
said the right
everybody.
direction. But good conversation, guys. Thank you.
Thanks, everyone. Nice meeting you, Kate.
Bye.